October 19, 1987. The Dow Jones Industrial Average fell 22.6%. The S&P 500 fell about 20.4% in one session. Under a plain normal model, using long-run daily U.S. stock return parameters, that move sits in a tail so small it might as well read zero. But Black Monday was not just a bad day for prices. It was a day that broke two elegant ideas at once. First, that extreme losses live safely in thin tails. Second, that if markets fall, you can hedge smoothly by selling as they fall. This is the story of the risk model that made 1987 look impossible, and the market structure that made it happen anyway. To keep this honest, the title needs one clarification. There was no single magical spreadsheet in 1987 that literally printed the word impossible. The cleaner truth is worse. A whole family of models shared the same comfort. Daily returns were treated as roughly normal. Volatility was treated as much more stable than it really was. And dynamic hedges were treated as executable because markets were assumed to remain liquid enough to trade through stress. The language later changed. Value, at risk, became standard on many desks in the 1990s. Expected shortfall came later. But the seduction was already there in 1987. If the distribution is thin-tailed and the hedge is continuous, the disaster zone looks both remote and manageable. Black Monday challenged both parts of that worldview. Let us make the claim concrete. This first calculation is ex post and model diagnostic. It is not a literal risk printout from a desk on the eve of October 19th. A CFA Institute summary of S&P 500 daily returns from January 3, 1950 through July 31st. 2012 reports an average daily return of about 0.03% and a daily standard deviation of about 0.98%. Now plug in Black Monday. If the S&P 500 falls about 20.4% in a day, the move is roughly 20.85 standard deviations below that mean. Under a normal distribution, the one-sided left tail probability is about 8.1 times 10 to the minus 97. That number is not a forecast of reality. It is a diagnosis of model misspecification. And to be fair, the market was not asleep before the crash. James Grant's work on implied volatility shows that by Thursday, October 15, 1987, expected equity volatility had already climbed to about 18.5% annualized. Even if you use that elevated pre-crash risk estimate, Black Monday is still about a 17.5 sigma event under a thin-tailed normal framing. So the point is not the exact exponent. The point is that any ordinary thin-tailed model makes this day look absurdly unlikely, not rare, absurd. And here is the deeper problem. Markets are not built from independent, well-behaved shocks with constant volatility. They cluster. Calm periods tend to be followed by calm periods. Turbulent periods tend to be followed by turbulent periods. That is exactly why Robert Engels' AR/CH models mattered so much later. They treated volatility as time-varying instead of pretending it was a fixed background constant. A bell curve can still be useful near the center. It can be a local approximation. But crisis risk lives in the tails, in regime shifts, and in feedback. And a model that is elegant near the center can be dangerously wrong at the edge. Black Monday was not only a distribution failure, it was also a hedging failure. Many portfolio insurance programs delivered downside protection by trying to synthesize a put-through dynamic trading rather than by buying one outright. In one simplified CPPI-style form, the logic worked like this. You choose a floor under the portfolio, then you measure the cushion above that floor, and you set risky exposure as a multiple of that cushion. So imagine a portfolio worth 100 with a floor at 90 and a multiplier of 3. The cushion is 10, so risky exposure is 30. Now suppose the market falls and the portfolio drops to 96. The cushion is now only 6. Target risky exposure falls to 18. So the rule tells you to sell 12. If the portfolio falls again to 92, the cushion is only 2. Target risky exposure falls to 6. So the rule tells you to sell another 12. That is the key mechanical insight. The lower the market goes, the more aggressively the strategy wants to sell. In practice, many portfolio insurers executed this logic in stock index futures because futures were cheaper to trade, and many institutions were not authorized to trade client stock directly. So the hedge was not a static shield. It was a rule that converted falling prices into more selling. What makes this story more unsettling is that some of the warning was visible before the crash. In August 1987, Sanford Grossman argued that synthetic strategies like dynamic hedging could themselves increase volatility. Why? Because a real traded option and a synthetic option are not the same thing. If the market does not know how much dynamic hedging is sitting in the system, then liquidity providers do not know how much sell pressure may arrive when prices move. And if they do not know that, they pull back. A week before the crash, public concern had already surfaced that portfolio insurance could turn a falling market into a rout. Then the backdrop worsened fast. In the days before Black Monday, markets were already under pressure. News of a larger-than-expected U.S. trade deficit pushed the dollar lower and intensified fears of tighter policy and higher rates. At the same time, proposed tax changes threatened the economics of takeover financing. By the close on Friday, October 16th, the S&P 500 was down more than 9% for the week. That mattered because many portfolio insurers ended the week with an overhang. Their models still wanted more selling if prices kept falling. Some institutions also began to sell in anticipation of those program trades. So before Monday even opened, the market was already primed for one-sided flow. Monday morning is where the theory meets the machinery. There was heavy selling pressure on the New York Stock Exchange right at the open, but many specialists did not open for trading during the first hour. By 10 a.m., 95S and P stocks, representing about 30% of the index value, were still not open. That means the cash index was partially built from stale quotes. Meanwhile, the futures market in Chicago opened on time and began dropping immediately. So now the market had a new problem. The cash market looked less down than it really was because many stocks had not traded. The futures market reflected the panic in real time. That gap invited index arbitrage, and once that machinery kicked in, pressure in the futures market was transmitted back into the stock market. This is one of the most important lessons of 1987. The cash market, futures market, and options market were not truly separate. Under stress, they were one system. Once the loop begins, it becomes self-reinforcing. Prices fall. Portfolio insurers sell. Futures fall further. Index arbitrage transmits that pressure into stocks. As stocks finally open, they gap lower. That lower price forces more model-driven selling. And because the market is now moving in discontinuous jumps, not smooth increments, the hedge itself becomes less reliable exactly when it is needed most. By the end of the day, the S&P 500 futures contract had fallen about 29%. The Dow, S&P 500, and Wilshire 5000 were down roughly 18 to 23% on the session. That is not a market calmly discovering a new equilibrium. That is a feedback system losing stability. The Brady Report contains one of the most sobering facts in the whole episode. The selling was concentrated in a surprisingly small number of institutions. On October 19th, sell programs by 3 portfolio insurers accounted for just under $2 billion in the stock market. In futures, 3 portfolio insurers accounted for the equivalent of $2.8 billion of stock, and a few mutual funds accounted for about $900 million of stock sales. Those numbers do not sound huge by today's standards. That is exactly the point. Only about 3% of total publicly traded U.S. shares changed hands during the break, yet the market lost about $1 trillion in value. What looked like abundant liquidity in normal times turned out to be shallow, conditional liquidity. It was there only as long as not everyone needed it at once. Now, the correction. Portfolio insurance was not the whole cause of Black Monday. Mark Rubenstein later argued that portfolio insurance may have accounted for only about 12% of the dollar change in net sold positions on October 19th. He also pointed to the twin deficits, the falling dollar, and wider uncertainty about the market system itself. That is the balanced view. Macro stress set the stage. Crowded dynamic hedging and fragile market plumbing made the decline far more violent. So if you tell the story as the crash was caused by computers, you are simplifying too much. But if you tell the story as fundamentals alone did it, you miss the most important mechanism. The real lesson is interaction. Bad backdrop, crowded rules, one-sided positioning, weak market structure. That combination is what turned a sell-off into a cascade. So what actually failed? Not mathematics. Boundary conditions. The distribution was too thin. Volatility was too state-dependent. Selling was too endogenous. And liquidity was treated as a constant when it was really a fair-weather resource. The model did not have to be insane to fail. It only had to be slightly too clean. And markets do not punish slightly too clean assumptions gradually. They punish them all at once. After 1987, risk management did not abandon models. It changed the kinds of models and safeguards it trusted. Regulators moved toward circuit breakers and better cross-market coordination. Quant finance moved harder into time-varying volatility, stress testing, and a more explicit focus on tails. And after the global financial crisis, Basel shifted market risk capital from value at risk toward expected shortfall and added liquidity horizons, explicitly acknowledging two facts. Tail losses matter, and the time required to exit risk matters too. That does not mean the problem is solved. It means the industry was forced to admit that a neat center of distribution model is not enough for crisis management. The risk model did not say Black Monday was physically impossible. It said the event was so improbable that you could mostly ignore it. And it said that if prices fell, you could trade your way through the hedge. Black Monday showed why that confidence was misplaced. In markets, the biggest errors are often not arithmetic errors. They are system errors. Mistaking a calm period approximation for the full machine. Mistaking quoted liquidity for real liquidity, mistaking a synthetic hedge for an actual guarantee. That is why 1987 still matters, because modern finance keeps relearning the same lesson. The model is most dangerous where it looks most elegant. Markets are not shaped only by what is likely. They are shaped by what becomes possible when fear, leverage, crowding, and disappearing liquidity hit the same tape. This video is for education only, not financial advice.